Welcome to the video. All that glitters is gold. Why precious metals did so well in 2025, and what is the outlook for 2026 and beyond. This video was prepared by Vedanta Sentinel Investment Advisers. We are an independent investment advisory firm based in Ann Arbor, Michigan, and we work with clients locally here in Michigan and throughout the U.S. We offer a no-obligation portfolio review consultation. If you have an interest in discussing your investment and portfolio needs, please check out our website at vedantasentinel.com for additional information or to schedule an appointment. All content is for information purposes only. It is not intended to provide any tax or legal advice or provide the basis for any financial decisions. Nor is it intended to be a projection of current or future performance or indication of future results. Opinions expressed herein are solely those of Vedanta Sentinel Investment Advisers. As the chart shows, last year, the precious metals complex did really well. Silver was the top performer as an asset class, up over 148%, followed by gold at 65%. On the flip side, US dollar was down over 9.4%. Bitcoin aka digital gold was down 5.5%, and crude oil, using Brent crude as the proxy, was down by 18.5%. A lot of investors are jumping on the silver and gold bandwagon and asking questions, so we have prepared this special presentation discussing the shiny metals. First of all, a little bit of education. Gold generally works best as inflation hedge, crisis hedge, tail risk insurance, currency debasement hedge, and as a portfolio diversifier. It tends to perform best when real interest rates are falling or negative, monetary credibility is questioned, and financial or geopolitical risk is elevated. We can now try to make sense of why the metals complex did so well in 2025 and what lies ahead. What happened in 2025? 1. Geopolitics, tariffs, and inflation fears. A new U.S. president came into power. His first order of business in 2025 was to upend the current global trade regime by announcing heavy tariffs on all countries. He announced highest tariffs in a century. What does that mean? High unexpected inflation outlook. Then the president constantly put pressure on the Fed to lower rates. Against this backdrop, the US dollar lost around 10% value in 2025. Then the US attacked Iran's nuclear facilities in late 2025. This is in addition to the ongoing Gaza war, plus the Russia-Ukraine war escalation provided a favorable geopolitical backdrop for the gold. 2. Central bank buying. Over the years, central bank buying has picked up. In 2025, provided a further impetus. 3. Investment and speculative demand. With the proliferation and financialization of all assets, including gold, the investor demand has been picking up over the last 2 decades. So all of the reasons aided the strong performance for the entire precious metal complex in 2025. This chart illustrates gold's total performance during 11 major stock market drawdowns. The yellow bars demonstrate gold's value as a crisis hedge when equities underperform. Central bank gold reserves have steadily increased, a trend that accelerated since 2022 due to geopolitical risks. Gold holdings as a percentage of reserves have risen significantly since the low point around 2008. Annual central bank gold demand has remained strong since 2022. The chart shows a substantial increase in demand, continuing strongly through the third quarter of 2025. Central banks, notably China and Russia, have been among the leading buyers of bullion. This table shows the significant increase in their gold holdings between 2000 and 2024. Japan, Italy, the US, France, and Switzerland have been net sellers over the last 2 decades. Looking at the demand statistics, we see the various segments for gold's demand, including jewelry, technology, investment, and central banks, overlaid with the gold price trend over the last decade. The breakdown of gold demand generally consists of about 50% from jewelry and industrial uses, with the other 50% coming from investors and central banks and other institutions. Side notes: total mined gold through human history, 218,000 tons. Unmined but recoverable is approximately 64,000 tons. So about 20 to 25% of known economically viable gold remains unmined today, below the ground, and about 75% is already mined, above the ground. Since the introduction of gold-backed ETFs around 2005, the real price of gold has shown an upward trend, illustrating structural changes and the financialization of the metals complex. This chart shows the gold ETF price alongside options trading volume. The strong upsurge in options and call buying in 2025 suggests increasing short-term speculative demand. This historical monthly chart of gold prices shows the long-term moves in the monetary metal, highlighting major price peaks and troughs since 1970. plotted against the backdrop of the US dollar index. Starting on the left from year 1971, when the US President Nixon decided to let go of the US dollar pegged to gold when it was around $35. The vertical green lines are important inflection points in gold's price history. There is a lot of contextual information worth discussing in this and the following charts. It is hard to elaborate it in this short video. However, we urge you to contact us if you have additional questions or curiosity about the moves in the gold market over the last 50 years. Here we see the long-term gold to silver ratio, alongside the historical prices of both metals. This ratio gives insight into the relative valuation of gold versus silver. People need to remember that silver is typically a byproduct for gold miners. Silver is a levered play on the mining sector. With the spike in silver prices recently, this ratio has come down close approximately 50 after this extreme move. There is clearly a speculative frenzy surrounding the white metal, but it can continue a bit further. The gold-silver ratio is a macro regime indicator. High ratio equals fear, tight liquidity, deflation risk. During the COVID deflationary scare, the gold-to-silver ratio touched 112, an all-time high. Low ratio equals growth, inflation, speculative appetite, as we see right now. Here's some anecdote from the Reuters article this week, highlighting the sentiment associated with silver. Retail investors have poured record amounts into silver, with suggesting a structural accumulation beyond a typical, quote, meme stock spike. So far, we have discussed the macro backdrop and the technicals. Now let's turn to the fundamentals to get a full handle on the investment thesis and whether you should or should not buy metals at these levels in January of 2026. There is an industry standard to understanding the cost of mining these metals. It is called the all-in sustaining cost. AISC equals all-in sustaining cost. It is a comprehensive metric that estimates the total cost to produce an ounce of metal while sustaining current production levels over the long term. It was formalized by the World Gold Council, WGC, in 2013 for gold. It is now widely used for other metals, like silver and copper, often adapted by companies reporting co-products. AISC goes beyond simple cash costs and typically includes direct operating costs, sustaining capital expenditures, corporate overhead and administrative costs, environmental and reclamation costs, and byproduct credits. Key takeaways. Silver AISC varies dramatically based on whether operations are primary silver mines or polymetallic mines, with significant byproduct credits, gold, zinc, lead. Byproduct credits are crucial. They can reduce reported AISC by 50 to 80% in some cases, particularly for silver and base metal operations. Geographical and regional variations matter. The substantial difference between the average AISC and the spot price highlights the extremely favorable margins for miners in 2025. And that's why the mining industry and stocks are also at record highs as we start 2026. Key insights on AISC and profitability. Gold. Producers are seeing super high profits. With AISC at $1,600 and spot gold at $4,610, the margin is nearly $3,000 per ounce. Silver. The supply deficit has pushed silver to the $90 range. Even high-cost miners, $30 plus AISC, are currently extremely profitable. Copper. Despite a 36% year-over-year price increase to $5.85 per LB, copper margins are tighter than precious metals due to the extreme capital intensity and declining ore grades in Chile and Peru. As you see on the chart, the miners, ETF, GDX, and the price of gold. The mining sector stocks have gone to the roof and are at record highs. We will hear from the mining companies beginning next week about their profitability and outlook for 2026. Looking ahead to 2026, the positives include the geopolitical narrative and an investor demand. However, if Fed decides to stay on hold, the US dollar may catch a short-term bid, thus hurting the metals complex. We also don't know how will foreign central banks react to higher prices. Will they keep buying? Investors must watch out and be mindful of the stretched bullish sentiment and extremely overbought technicals. If you are a long-term investor, we would not recommend buying the metals or the miners at these levels. It makes sense to wait for a deeper correction in gold, of at least 20 to 30%, before considering adding allocation to the metals complex. As always, this is not meant to be a personalized investment advice. Please check with your advisor and do your own due diligence before making any investing decisions. Thank you for your attention. Please call us at 734-234-8742 or 567-VEDANTA to leave a message. Check out our website at VedantaSentinel.com for additional information or to schedule an appointment.